You can board a flight in one hemisphere and arrive in a new city a few hours later. But while crossing a physical border is highly optimized, your financial identity and purchasing power remain trapped inside your home country's banking infrastructure. Your money does not actually travel with you. To spend it abroad, the funds have to be routed through a multi-layered chain of correspondent banks or international card networks. This maps a standard cross-border transaction. Each hop introduces friction. Processing slows, interchange fees compounding, and merchants apply dynamic currency conversion. Foreign transaction fees and exchange markups impose a 3 to 6% penalty, shrinking your capital before it ever reaches the merchant's account. These legacy architectures move messages rather than money. They operate as a series of toll bridges, extracting value from consumers and banks to facilitate data movement across geographic lines. The Digital Local Currency Program, operating commercially as Sendycate, offers a structural alternative to these legacy chains. By bypassing the intermediaries entirely, this architecture establishes a direct, API-driven partnership between two sovereign banks. This gives the consumer direct access to the destination country's domestic payment rails. They can use local QR codes and instant payment systems natively, straight from their home bank application. This architecture systematically removes the technical borders between existing sovereign domestic networks. Building this architecture requires the coordination of 3 distinct entities. Sendycate acts as a central harmonizing layer, providing the legal and technical framework. The foreign member bank manages the end-customer relationship within their mobile app. The supplier member bank provides onshore infrastructure, local regulatory coverage, virtual accounts, and API access to domestic rails. Rigidly separating the customer interface from the domestic rail execution allows foreign banks to offer localized financial services without acquiring foreign banking licenses. But the separation raises a mechanical challenge. A domestic bank must provision accounts and execute local payments for foreign users without waiting for a per-transaction cross-border wire to clear. The solution is a settlement current account on the supplier bank's balance sheet. The foreign bank pre-funds this, establishing localized liquidity. When a user purchases local currency, an API ping triggers the supplier bank to instantly provision a virtual account backed by that pool. This bulk pre-funding eliminates per-transaction FX latency. It converts a sluggish cross-border payment into an instantaneous domestic transfer. Historically, a domestic bank cannot host financial accounts for foreign individuals without conducting their own exhaustive Know Your Customer onboarding. Sendycate resolves this through a master services agreement utilizing a delegated KYC framework. The supplier bank legally relies on primary KYC performed by the foreign bank, allowing the user to access a domestic account without redundant identification documents. This reliance is supplemented by localized sanction screening and bilateral data sharing strictly aligned with the data protection laws of both jurisdictions. Standardizing this delegated compliance framework allows these bank-to-bank relationships to be stood up safely and rapidly. We can observe this infrastructure in motion through an inbound tourist. The tourist uses their home bank app to execute a domestic QR payment or a virtual debit card transaction. The entire data flow processes natively on the supplier bank's domestic rails. There are no dynamic currency conversion prompts, no foreign card surcharges, and no cross-border interchange fees interacting with the merchant. In a migrant worker use case, this domestic virtual IBAN can receive funds via local payroll rails. When the worker transfers a portion of that salary back to their home country, it flows through the bilateral API corridor, bypassing third-party remittance operators. The end user experiences a fully localized interface, while the underlying architecture manages the cross-jurisdictional settlements in the background. A domestic bank needs a commercial rationale to offer its proprietary rails to a foreign competitor's customers. The immediate impact is on the balance sheet. The pre-funded hard currency and resulting local balances sit as stable deposits on the supplier bank's ledger. By hosting the virtual cards and rail access, the supplier bank captures issuance fees, FX margin, and acquiring revenue that would otherwise be lost to third-party networks. Because the funds are native to the domestic rails, they circulate within the local economy rather than immediately exiting via cross-border wire. This framework allows supplier banks to convert latent foreign traveler and worker demand into domestic deposits by leveraging the foreign partner's existing user base. We have examined a single optimized bilateral corridor. As we zoom out, we can see the network effect. Because the MSA legal frameworks and API integrations are standardized, adding subsequent partner banks requires marginal effort rather than custom builds. This positions the Supplier Bank as the designated high-volume gateway for its local currency within a growing global ecosystem. In high-volume retail and B2B flows, this direct access model displaces traditional intermediaries, reducing the reliance on fragmented correspondent chains. Frictionless cross-border finance does not require a new universal rail. It requires the seamless bilateral interconnection of sovereign domestic ones.